Hello and welcome to Connect, the weekly podcast of the California MBA, featuring one-on-one interviews with movers and shakers in the mortgage industry. I'm Susan Milazzo, CEO of the California MBA, and very happy you could join us today. Before I welcome today's guest, I'd like to thank our 2025 President's Council sponsors. Now, these are companies that provide a tremendous amount of financial support to the California MBA, in large part so that we can continue to be the strong advocate before the California state legislature and our regulators for the real estate finance industry. So please join me in thanking this year's President's Council sponsors. And those companies are AmeriHome, Funding Shield, Guild Mortgage, Rocket Mortgage, Wiener Brodsky Kiter, and Western Alliance Bank. Thank you all so much for your support. We really appreciate it. And with that, I'd like to welcome today's guest. Welcome to Tom Delaney, who is president of Bankers Insurance Service. Tom, welcome.
Thank you, Susan. Good to be here.
It's so nice to have you. Tom and I have known each other for a number of years, and it's great to have him on Connect. I can't believe we haven't done this before, so I'm glad that it finally worked out. I usually like to start out with just some background on how people came into the mortgage industry. So why don't you share us your journey to the mortgage biz?
Oh, my journey to the mortgage biz. It's an interesting journey, and a journey into the insurance business as well. I got out of college and got my first job in Northwest Indiana at a savings and loan called Citizens Federal in Munster, Indiana. And they taught me mortgages and had me sit in the lobby and be the mortgage guy. And they did not pay me a commission. I was an hourly employee and I did not get paid a lot of money. So in the evenings, Monday, Tuesday, and Wednesday from 6 to 10, I would moonlight at a health club as a, believe it or not, fitness instructor. And basically what that meant was that when people joined the club and they came through and they needed to learn how to use the equipment, where everything was, I would take them through their first 3 workouts and show them how to do all that. So I was taking a woman named Eileen through one of her first workouts, and we were just getting to know each other. And she said, what do you do for a living? And I said, well, I work at this bank during the day, and but I kind of really want to get a job in Chicago, and I would like to work downtown Chicago. And she says, well, I work downtown Chicago for an insurance company, and just down the hall from us is this company called Bankers Insurance Service, and they sell insurance to mortgage companies. And I happen to know that they're looking to hire somebody. Would you like me to take your resume in? And I gave her my resume at the next workout. I got 2 interviews, and the next thing you know, I got a job as an underwriter at Bankers Insurance. That was 1994, and I've been there ever since.
So. Wow. All the years I've known you, I don't think I ever knew that story. That is very interesting. It's like one and done. Here I am. This is where I am. And now you're president of Bankers Insurance Service. Look at that.
And the funny thing is that we hire the same way today, which is it's rare to find somebody who knows both insurance and mortgage. So we either hire a mortgage person and we teach them insurance, or we hire an insurance person and we teach them mortgage. So in my situation, I knew mortgage and I didn't know anything about insurance, so they had to teach it to me, but it was a good fit. So
yeah, that is very interesting. Tell us about Bankers Insurance Service and what role the company plays in the mortgage industry.
Yeah, so Bankers got its start in 1952 when Fannie Mae decided they wanted their seller servicers to carry 2 kinds of insurance. They wanted them to have a fidelity bond, which is basically an employee dishonesty policy, and they wanted them to have a very specific type of errors and omissions insurance called Mortgage E&O. At the time, the Mortgage Bankers Association of America was located in Chicago, unlike DC, where it is now, but it was in Chicago. And so Fannie Mae got together with MBA, together with some Chicago insurance people. Again, this is 1952, so I wouldn't know who they were. And they created our flagship product called the Mortgage Bankers Bond that puts Fidelity Bond and Mortgage E&O insurance into the same policy. It's 2 policies in one, and creates a one-stop shop for a seller servicer to meet those insurance requirements of the GSEs. And over the years, warehouse lenders had started requiring this coverage as well. So that's our core product. And in 1952, that got placed into the Lloyd's of London insurance marketplace. So Lloyd's is actually the risk-bearing entity, and in the insurance world, Bankers is known as a managing general underwriter. So we do everything that an insurance company does, but we don't take the risks. So we solicit, underwrite, quote, bind, issue the policies, but the premium goes to Lloyd's, and if claims are to be paid, Lloyd's pays the claims. So that's really our role in the insurance industry, and our niche, of course, is the mortgage industry. Over the years, we've added different products to our contract with Lloyd's that include malpractice insurance, also known as professional liability, directors and officers insurance, cyber liability, mortgage impairment. So we've got many more policies than we originally had with the mortgage bankers bond to serve the mortgage lending industry where we specialize.
Yeah, yeah.
That makes sense?
Yeah, absolutely. Climate change is something certainly that is impacting stress on loan portfolios, servicers across the country. How is Bankers Insurance Services helping lenders in this area?
Yeah, it's interesting that just yesterday, the Fed chair testified before Congress, and one of his quotes was, if you fast forward 10 or 15 years, there are going to be regions of the country where you can't get a mortgage, having to do with insurance availability.
Insurance availability. Yeah.
Yeah, and you know all about this in California and recent
Yes.
events, obviously, in Los Angeles. And all these carriers that have pulled out of California and aren't writing risks there, aren't insuring property there any longer. And that puts pressure on a loan servicer because it just increases the probability or the possibility that a collateral property goes uninsured, right? Because a borrower might find themselves in a position where their homeowner's carrier is not renewing them or won't write their policy any longer. So obviously, a servicer is going to have a lender-placed program that they can rely on, but they have to engage properly and make sure that that collateral property remains insured, or they might pick up a liability to the investor for whom they're servicing that loan. So there's an increased probability of an error omission happening. From a first-party exposure, if you think about portfolio lenders and climate change, they have additional exposure to situations where a collateral property could be damaged or destroyed by an event that the borrower was not required to insure the property against. So if you think about flood outside of a high hazard flood zone, the borrower would not have been required to buy flood insurance as a condition to get the mortgage. Well, what happens when that property floods, right? So we're seeing, again, parts of the world are flooding that typically don't flood. Something like 5% of the Fannie Freddie owned mortgages that were impacted by hurricanes Helene and Milton did not have flood insurance in place.
Wow.
Right? So what happens when the borrower returns to their property to find it flooded? They have no insurance with which to repair the property. They can't use it. They can't live in it. Depending on their equity position, are they going to continue to make that mortgage payment? Probably not. So the bank's going to foreclose, the portfolio lender, the investor in that mortgage is going to foreclose on a damaged or destroyed asset. There's going to be some land value there. For simple math, let's say it's $100,000 outstanding loan balance. They can foreclose and resell the land for $50,000. They lost $50,000 on that loan. That is what our mortgage impairment product covers. So that's really where we, like, not only from an errors and omissions perspective within our mortgage bankers bond, but also in our impairment program for servicers when they might make a mistake. There's also coverage for situations where a collateral property is damaged or destroyed, and it was destroyed by a non-required peril. The borrower was never required to insure the property against that. And specific to California, for purposes of this call, think about earthquake insurance.
Yeah.
An earthquake is typically not required. So,
right.
A portfolio
strongly suggested in some areas, but not required.
Yeah. So a portfolio lender would be sitting on that exposure. And we have a mortgage impairment product that could cover that risk.
So in addition, thank you for that. In addition to, climate change, and, the natural disasters that, we have seen here lately in California, cybersecurity just continues to be very high priority for my lender members, all my members really. And it seems like no matter what new things we come up with, the fraudsters still kind of come up with something. They're always one up in their game. So how does bankers help lenders in that area in cybersecurity?
Yeah, so as I mentioned earlier, we do have a cyber liability product that is placed into the Lloyd's of London marketplace. The main coverages that are contained in a cyber liability policy include breach response, which is basically in every state, if a mortgage company has a data breach and client personal information is compromised, they're required to notify all of their clients that they've had a data breach. We've all received those letters in the mail, either from Home Depot, Zappo, or somebody that's had a data breach saying, "Hey, your information might have been compromised." So a good cyber liability policy will notify clients on behalf of the insured. The policy also contains third-party coverage, which basically is going to pay defense costs and damages if the mortgage company gets sued by those affected clients. So it's kind of a malpractice, almost an E&O type coverage there. There's also first-party coverage in the policy for things like business interruption. If a computer system or a service gets locked down by a cyber criminal and the mortgage company can't close loans and they can't continue to do business, there's some relief provided in the policy by in the way of business interruption coverage there for first-party type loss. And then there's the crime section, which would be your ransomware events, where obviously a system gets locked down, a ransom is demanded. The policy will actually pay that ransom and get the computer system freed up so that business can be done and loans can be made. And then there's a little bit of social engineering in there too, where if money is wired to some third party because of a deep fake, and you think about AI these days and how like people can be
Good Lord, I
recreated,
know, my
voices
word.
can be redone so easily that money can get wired to the wrong place on false instructions. And so there's a component of that in a cyber liability policy. So the thing with cyber is that it's not a required coverage by the GSEs or by warehouse lenders. We really, really recommend that our clients buy it, but they don't have to buy it. And all too often we hear clients, Main Street mortgage companies, who will say, "I'm not a target. I'm not big enough. Nobody's going to hack me." And it's just not, actually, it's the opposite, right?
Yeah,
You don't have the cybersecurity in place that Chase and Bank of America and Wells do. You're the prime target as a smaller lender who has a ton of client information. If you think about a loan application,
yeah,
everything, I mean, it's all right there for the taking. So,
all
you know,
right there. That kind of
yeah,
leads to my kind of sub question on this because I've heard, panels and things on this. What are some of the elements that lenders typically overlook when they're looking into a cyber policy? I mean, you kind of answered one, like, I'm too small, I'm not really a target. Well, that's just overlooking the whole policy. But I
that's
mean,
right.
just you've got to know that everybody's a target.
Hmm. Yeah, I think that's the main thing is they just overlook the fact that they are a target for a crime like that. And I mean, in terms of the coverage, I mean, I probably, with a good cyber liability policy, you also from the carrier that is insuring you, there are certain risk management services that come along with that policy. So you get access to, say, videos or manuals that will help you actually put up some defenses so that if you do get hacked or attempted hack, there isn't a loss in the first place. So these risk management tools that a lot of times come bolted onto your cyber liability insurance policy are often ignored. And sometimes I don't think probably sold well enough by insurance agents or whoever the producer might be because they're really valuable.
Yeah, you've got to make sure your team, that's your first line of defense, right? They got to make sure
Yeah,
they know what they're doing.
yeah, exactly, exactly.
Tom, as I'd said at the beginning, you and I have known each other for a long time, and Bankers Insurance Service has been a big supporter, longtime supporter of the California MBA, for which we are very grateful. Can you share with our listeners why you choose to support our organization?
Sure. Well, I mean, the simple economics of it are, California being the fifth largest economy in the world and a huge mortgage market. Actually, 20% of the policies that BIS issues are in California. So we need to be engaged in this state, and we need to keep our finger on the pulse of what's happening in California. And so obviously California MBA is key to that. And of course, number one, from an organizational standpoint, has to be you and your staff. The professionalism with which you run the California MBA is really impressive, and it's just great to work with you over the years. One of the top state organizations in the country, obviously. So it's you and your staff that has a lot to do with it. And you think about the insurance that we offer, it deals with fraud and crime, it deals with regulatory type violations, it can deal with compliance related matters, contingent property damage. All of this is operational risk type insurance, right? So we need to know what's happening from a state regulatory perspective, and your lobbying efforts and the things that you are doing at California MBA to make it a safe lending environment in California is very important to us. So the information that you provide to us and to your membership on what's happening in Sacramento is really, really important. So we really value that information that we get from you. And that bleeds into the cadence with which you provide the information, whether it's through email blasts or through your conferences, which are always great at great locations. That doesn't have anything to do with why we're a member. The information you provide is very, very consistent, and it's very valuable, and it just allows us to run our book of business and our business more effectively when we have access to that information. So it's some of the best money that we spend at this.
Excellent. Well, thank you so much for your kind comments. I appreciate that. And thank you for being on Connect. This has been fun.
Okay, great. Thanks for having me.
And thanks to all of you for joining us today. To access any of our past episodes, you can follow us on our YouTube channel. We're also available on SoundCloud, Apple Podcast, and Spotify. That's it for this week, and we'll see you next time on Connect.
Here we go.